in just the last 5 years, the average American's view on how much money they're going to need in order to retire has increased 50%. I've been a financial advisor now for over 20 years, and that's the most rapid increase in expectations for how much money you're going to need to retire that I've seen in my career. So let's go for a walk and let's talk about it. First, I want to credit the study's creator, which was Northwestern Mutual, and it's their 2024 Planning in Progress study. And in that study, the average American felt that they were going to need just under $1.5 million in order to retire. And in 2020, that number was less than $1 million. It was $950,000. So I think it's important to look at the breakout in it by age group, because there is a standout, and that is the boomers. The boomers, the baby boomers, the boomers, the last of the boomers are going to turn 60 years old in 2024. And the boomers thought, you know what, we need closer to $1 million. It was about that 950,000. It was the other generations, the younger generations, and most of them thought that they were going to need $1.6 million. So first there's an age difference. And I think part of that is, you know, the boomers are close to retirement, and it's less likely that if Social Security gets cut, that people currently taking Social Security or very close to Social Security are going to be impacted as dramatically as people that maybe are a decade or 2 decades or more away from being able to retire. So I think that's part of this. And then the reality is, you know, we've all seen inflation go up quite a bit in just the last 2 or 3 years, right? Inflation is up about 20% since the start of the pandemic. So it's just natural for many of us to look at today's data and to bring that forward into the future. And so somebody that's 20 years away from retiring, I can see where they're like, you know what, I'm going to need a lot more money, because really for 2 decades, inflation was very tame, was very low, historically very low. And now that's changed, right? It peaked out at a little under 10%. And the Federal Reserve has brought that down. We're now in the high 3s, the low 4%. But you know what? That last mile of inflation can take a long time to get under control. So interest rates could be higher for longer, and inflation could be higher for longer. So I think that's part of it. So one is just recent inflation. And obviously that's had an impact on us. You go to the grocery store, food prices have gone up quite a bit. So it's increased prices, really food, energy, and housing. The price of houses have really dramatically increased. And what that means is we don't often think about it, but when we buy a house, we put down 10 or 20% on the home, and we borrow the rest from the bank. That is, hopefully our home appreciates over the time that we own it, and hopefully it appreciates at a rate higher than the interest rate that we're paying on it. And if so, we're kind of making money on borrowed money, right? Let's say you buy a home for $500,000, you put $100,000 down, and you finance the other $400,000. It wasn't that long ago you could get a mortgage at 3%, let's say. Well, the likelihood that invested money over 30 years is going to be 3% a year is pretty high. And so essentially, you know, if you had $500,000 that you could have paid cash for the house, instead you borrowed $400,000, you're making money on that mortgage that you borrowed. And so people that cannot afford to get into a home today don't have that advantage. When they're renting, there is no return on the leverage, return on the debt that they've borrowed. And certainly at today's interest rates, which as I record this is north of 7%, you know, are you likely to beat 7% in a diversified stock and bond portfolio? I don't know. None of what I'm sharing with you today is financial advice. I don't know your situation, but I could say, obviously it's a heck of a lot harder to beat that number. Is it possible? Yes. Is it likely? Maybe. I don't think so. but different people will have different views on it. So even if people can beat the borrowing cost in today's, if they can buy a home, they're likely not going to beat the current interest rate on their investment. So that's another one. Another thing is just the world's much more uncertain today than it was a decade ago, right? A decade ago, we were still benefiting from the peace dividend, at least geopolitically, with the major powers. The world was a much more peaceful place than it is today. Yes, I know Iraq and other wars that the U.S. was involved in, but that really wasn't major powers going fighting against each other, and we don't have that now. But we do have the possibility, right there. Is there a possibility of a conflict with China and the United States? There definitely is, and it's increased. Same thing with Russia. So the world's a more uncertain place, and probably the thing that comes home to roost the most is uncertainty over Social Security. The Board of Trustees for Social Security, that's chaired by Janet Yellen, has said that the trust fund, the excess capital that's paying out benefits above what the tax receipts are right now, those benefits right now are getting paid out. That trust fund is going to run out of money, according to Janet Yellen, by 2034, which, as I record that, is just a decade away. So it's, politically speaking, it's right around the corner. So there's uncertainty of Social Security, which is an important leg to the retirement stool that we have. Looking at Social Security, it doesn't mean Social Security is going to go away. I want to make that clear. But it does mean that the tax revenue, if it continues at where we're at today and how it's running today, the tax revenue will only cover 70 to 80% of the benefits that are being paid out now. Now, do I think Social Security is going away? No, I don't. Do I think we're looking at a 20 to 30% cut in Social Security benefits? No, I don't. But yeah, it's not my area of expertise. Again, this is not financial advice. This is just my personal opinion based on my life experiences and what I'm reading. So, okay, another source of uncertainty that's really important, and this is going to impact, according to Goldman Sachs, over half of us. And that uncertainty is, how long are we going to be able to work? Goldman Sachs says that over 50% of us are going to be forced to retire before we're planning on retiring. And a big piece of why that happens is for health reasons. The three biggest reasons are our personal health doesn't stay as strong as we want it to. A second one in that is that we have to take care of other people. Elderly parents or adult children that maybe have a hiccup in their life and need our help. And maybe we have to retire in order to spend that time. And then unfortunately, over 10% of us are going to be laid off before our retirement age. And if we get laid off at 55 or 60 and above, you know, it's going to be hard to get another job like what we had before we got laid off. So that's another source of uncertainty. And then the final one, and you know, many of these have been out of our control, but the final one is something that's in our control. And that is, many people do not have a financial plan. And if you don't have a financial plan, you really don't know how much it's going to cost to retire. The difference between two people in a very similar situation, two families, two couples in a very similar situation, and how much they need to retire can differ dramatically. Again, I've been a financial advisor now for over 20 years. I've helped hundreds of families transition into retirement. And you can have two families that live in a similar location, that are the same age, that are making similar amounts of money, that have similar health profiles, but they could have dramatically different amounts of money that they need to retire. Let me give you for instance. I live in a ski town. If somebody's passion is skiing in the winter and mountain biking in the summer, you know, season pass prices for skiing have gone down quite a bit. That, if their homes are paid off, that can be a fairly inexpensive retirement. versus somebody that maybe wants to travel around the world and stay in 4- and 5-star hotels and do expensive cruises. So one of the first questions I ask somebody when they get ready to retire is, you know, what does retirement look like for you? What do those expenses look like? And again, two people in very similar situations, one person could say, you know, it's $5,000 a month. The other person could say $10,000 a month. Well, those are dramatically different amounts that they need to save, particularly if, you know, Social Security is going to cover 60–70% of the amount that they want to retire. Then their savings only have to cover the other 30–40%. So those are the major reasons why I think people are saying now you need 50% more. One is inflation and the other is really uncertainty. And on this, if you're curious, what does the average person spend? What do they make in retirement? That's why I made this video here, the average income for retirees in America. Thanks for watching this video, and I'll see you in there. Bye-bye.